Once again, I welcome you in the another episode of Accountancy. Today we are going to see how the common size statement of P&L has to be prepared. In last class we studied the common size comparative balance sheet. So the only difference between these two statements is that in common size balance sheet, what we did, we took one figure as a common, total asset and total liability. On the basis of that amount, we calculated the percentage. We converted the amount into percentage. Same process here we are going to follow, but the difference is that we are not going to take the total. We are going to take the revenue from operation as a base. Revenue from operation as a base. On the base of that amount, what we are going to do, we are going to convert the amount into percentage in order to assess ourselves that whether we are better than previous year or not. Okay? So come to the format. The format will be the same what we studied in last episode. Okay? In common size balance sheet. You're getting the point? So matter will be the same. First Roman letter, we have to record the revenue from operation. Revenue from operation. Revenue from operation means sales minus sales return. Sales minus sales return. Then we have to record another income if income is given in the practical. That has to be recorded. After recording other income, next process is to add these two heads, Roman letter 1 and Roman letter 2. You will get the total revenue. Okay? Total revenue means total income generated. Clear? Then we have to record all the expenses one by one. Okay? So first of all, we have to record cost of material consumed. Cost of material consumed. Cost of material consumed means opening stock, purchase of material, opening stock plus purchase of material minus closing stock material. Whatever the amount you get, that has to be recorded over here, cost of material consumed. Next, purchase of stock in trade. Under this head, what we are going to record? Net purchase. Net purchase means purchase minus sales. Purchase minus sales. Whatever the figure comes, that has to be recorded. Then the third one, change in inventories of finished goods, work in progress and stock in trade. Okay? So change in inventories means opening inventories minus closing inventories of these items. Whatever the amount comes, that has to be recorded under this head. Then employees benefit expenses. Employees benefit expenses such as wages, salaries, bonus, staff welfare fund, that has to be recorded if it is given in the practical. Then finance cost such as processing fee, interest paid, discount on loss of issue of debentures, that has to be recorded under this head, finance cost. Next, we have to record depreciation. The depreciation means the reduced value of tangible asset. Has to be recorded. Similarly, amortization. If any amortization is there, that has to be recorded. Amortization means the reduced value of intangible asset has to be recorded. And the last one, if any other expense is given, that has to be recorded. After recording all the expenses, next step is to find out the total expense. adding all the expenses. And whatever amount comes, that has to be recorded against fifth Roman letter against the head total expenses. This one is total expenses. Got it? Then next process, we generated income. We know what is the income and how much expense we incurred. We got the information. Now the next step is to find out the profit or loss, whether we are in profit or loss. So what we have to do? Simply we have to subtract these two heads, income minus expenses. Income minus expenses. It means income means third point, third minus 5. Roman letter third minus 5. And income minus expenses. When you subtract these two heads, and if you get positive figure, it will be termed as profit. It will be termed as profit. If you get negative figure, it means it's a loss. Simply. So that has to be recorded over here. Okay. Profit before tax. Profit before tax. Because on this amount, tax is not deducted. Income tax is not deducted. So that's why we recorded this head as profit before tax. And then if tax is given, that has to be subtracted. Less income tax. After subtracting whatever the left out amount, that has to be treated as profit after tax. Profit after tax. Okay. So these are the process by which we have to prepare common size statement of P&L in order to know the profit or loss of the company. Then how the comparison has to be done? Simply two amount columns are there, and in these two amount columns we have to record the details as per the numerical. Okay. First column is meant for previous year and the second column is meant for current year. All the previous year informations are recorded here, and in this column all the current year informations are recorded. And then what we have to do? We have to find out the percentage. Percentage of previous has to be recorded in this column, and percentage of current year has to be recorded in this column. Got it? Percentage of previous year in this column and percentage of current year in this column. How the percentage has to be calculated? Simply, in the beginning I told you we used to take one figure as a base, that is revenue from operation. So here the revenue from operation is 10 lakhs. So this will be the base for previous year and this will be the base for current year. How the percentage has to be calculated? See, for previous year, 10 lakhs into 100 divided by 10 lakhs. 10 lakhs into 100 divided by 10 lakhs, you get 100%. Similarly, 8,70,000 into 100 divided by 10 lakhs. You get 72%. You getting a point? Similarly, current year also, 12,50,000 into 100 divided by 12,50,000, you will get 100% in the current year. 7,20,000 into 100 divided by 12,50,000, you will get 69.60%. Like this, you have to calculate all the percentage one by one. And after calculating percentage, we can easily analyze our data. We can compare our business with the current year information with the previous year information, and we can predict that we are better than previous year or not. Okay, so common size is prepared in order to analyze ourselves and to check ourselves whether we are better than previous year or not. See you in next episode.